Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries behind corporate filings, and today we are diving into Stitch Fix Inc.'s latest proxy statement. This is not your average company update, it's more like peeking behind the curtain at how a company really operates and what its leaders are focused on. Get ready for a deep dive into executive pay, board decisions, and what the company's financial numbers are really telling us about its direction. Grab your popcorn, and if you want more of these decoded insights, join our Discord community linked in the description below. Alright, so Stitch Fix has released its proxy statement for its 2025 annual meeting of stockholders, which is coming up on the 11th of December 2025. And this is where they let us know what they're voting on, who is running the show, and how much everyone is getting paid. First off, the meeting is happening virtually, which is pretty common these days. They are asking stockholders to vote on electing 2 directors approve executive compensation on an advisory basis, which is your chance to say yay or nay on how much the top brass is getting paid and ratify the selection of Deloitte and Touch LLP as their independent auditors. Now, when it comes to voting, it boils down to who is a stockholder of record, meaning the shares are directly in your name, or if you are a beneficial owner, meaning your shares are held by a broker or bank. Each class A share gets 1 vote and each Class B share gets 10 votes. So Class B shares carry a lot more weight. Let's talk about the directors. They are proposing 2 nominees for election, Kofi Amu Gottfried and Timothy Baxter. Both are currently directors and are being put up for another term, Mr. Amu. Gottfried is the Chief Marketing Officer at DoorDash, and Mr. Baxter is the retired CEO of Express Inc. They seem to be bringing in experience from big tech and retail, which makes sense for a company like Stitch Fix. Kofi Amu Gottfried has been on the board since December 2022, and his marketing expertise at companies like DoorDash and Facebook is highlighted. They think his experience as a marketing executive at tech companies is valuable. Timothy Baxter joined the board in October 2024. He was the CEO of Express Inc., a fashion retailer, and spent over 25 years at Macy's. His experience as a chief executive officer of a publicly listed apparel retailer is seen as a key qualification. Matt Baer, the current CEO of Stitch Fix, is also continuing on the board until 2026. His background as chief customer and digital officer at Macy's and vice president of e-commerce at Walmart.com shows a strong focus on digital transformation and customer experience. And of course, Katrina Lake, the founder of Stitch Fix, has been a director since inception and is the executive chairperson. Her deep involvement from the very beginning is highlighted. The board seems to be pretty independent, with most of its members qualifying as independent directors according to NASDAQ rules. They've got a structure with an executive chair, Miss Lake, and a lead independent director, Miss McCollum, which they believe strikes a good balance between leadership and independent oversight. The board takes its role in risk oversight seriously, with various committees like the Audit Committee overseeing financial risks and cybersecurity, and the Compensation Committee looking at compensation practices and their potential impact on risk-taking. The Audit Committee is responsible for overseeing the financial reporting and audit processes. They've got 2 Audit Committee financial experts on the committee, which suggests a strong focus on financial integrity. The Audit Committee has reviewed the financial statements for the fiscal year ended the 2nd of August 2025, and they are recommending that these statements be included in the company's annual report. This is standard procedure, but it means an independent check has been done. Now, let's get to the juicy part, the executive compensation. The Compensation Committee is tasked with overseeing compensation policies and determining pay for execs. They look at CEO pay, other executive officers, and senior management. This section is where they really break down their compensation philosophy. Their goal is to attract and retain top talent, reward performance, and align the interests of executives with stockholders. They use a mix of base salary, annual cash bonuses, and long-term incentives like stock awards. They do a good job of outlining what they do and what they don't do. They retain an independent compensation advisor. They focus on performance-based compensation, and they have a stock ownership policy requiring executives and directors to hold a minimum amount of stock. What they don't do is offer special executive retirement plans or perquisites. This is a good sign that they are trying to be fair and not overindulge the top brass. The stock ownership policy is interesting. The CEO needs to own shares worth 5 times his base salary or 850,000 shares, whichever is less. For other executives, it is 2 times their base salary or 220,000 shares. This really ties their personal finances to the company's success. They also prohibit directors and officers from hedging or pledging company securities. This means they can't make risky bets on their own company's stock or use it as collateral, which is a good governance practice. They really emphasize a performance-based approach. They have an annual bonus program and use performance stock units, which are tied to achieving specific financial and strategic goals. This means a good chunk of their pay is not guaranteed and depends on the company's results. Okay, let's look at the numbers. For the fiscal year ended the 2nd of August 2025, Matt Baer, the CEO, had a total compensation of over $10 million. A big chunk of that, over $7.8 million, comes from stock awards. His salary was $850,000, and he received over $1.4 million in non-equity incentive plan compensation, which is basically his bonus. David Aufderhaar, the CFO, had a total compensation of nearly $4 million, with over $2.8 million from stock awards. Casey O'Connor, the Chief Legal Officer, had a total compensation of over $2.5 million, with about $1.6 million from stock awards. And Anthony Bakos, the Chief Product and Technology Officer, had a total compensation of almost $4 million, with over $2.8 million from stock awards. Looking at the awards granted in fiscal year 2025, the stock awards are substantial. For Mr. Baer, the stock awards alone in July 2025 were valued at over $1.5 million. These are structured with performance conditions tied to stock price hurdles, meaning they become more valuable as the company's stock price increases. As of the 2nd of August 2025, the unvested equity awards held by the named executive officers are quite significant. For example, Matt Baer has over 724,000 unexercised options and over $9.4 million in unvested RS. This shows a strong incentive for them to perform well long term. This next part is always interesting: potential payments upon termination or change in control. If a named executive officer is terminated without cause or resigns for good reason, they could receive severance. If this termination happens around a change in control of the company, the payouts are much larger. For instance, Matt Baer could receive severance payments totaling over $2.1 million, along with accelerated equity vesting worth over $10 million in the event of a change of control and termination. This double trigger arrangement is designed to keep executives focused on deals that benefit shareholders, even if it means their own job might be at risk. And then there is the CEO pay ratio. The annual total compensation for their CEO, Matt Baer, was over $10 million, while the median employee compensation was about $34,000. This results in a pay ratio of 298 to 1. While this might seem like a big gap, remember this is typical in many large corporations. And Stitch Fix does explain their methodology. This section is crucial. It compares the compensation actually paid to executives with the company's financial performance, like total shareholder return, net loss, and adjusted EBITDA, over several years. Looking at fiscal year 2025, their compensation actually paid to PO or Principal Executive Officer was $11.2 million. The compensation actually paid to the average non-PO NEOs was about $4.8 million. Their total shareholder return for 2025 was 20.27%. This chart shows how their compensation actually paid, or CAP, has tracked against their total shareholder return and their peer group's return. Over the last few years, the compensation actually paid has generally gone up while their shareholder return has been more volatile. This is something to keep an eye on. And when you compare compensation to net income or loss, you can see the executive pay has remained relatively high even during periods of significant net losses, especially in 2024 and 2023, when the net loss was in the hundreds of millions. The adjusted EBITDA chart shows a similar pattern. As the company's adjusted EBITDA has fluctuated, executive compensation has remained significant. In 2025, their adjusted EBITDA was almost $49 million, a positive step from a negative adjusted EBITDA in 2022 and 24. This indicates improved operational performance. Director compensation comes through in cash retainers and equity awards. Independent directors receive an annual retainer and additional fees for committee work. They also get restricted stock unit grants which vest over time. For fiscal year 2025, independent directors like Sharon McCollum received over $317,000 in total compensation, with over $122,000 in cash and almost $195,000 in stock awards. J. William Gurley received over $304,000. Katrina Lake, as executive chair, receives less compensation being an employee, around $80,000. This section deals with any deals involving folks with close ties to the company. They disclose that Chelsea Lake, the sister of Katrina Lake, was employed as a buying director and received compensation of over $255,000 in fiscal year 2025. Her compensation was determined by market data and internal pay equity. So looking at all of this, Stitch Fix is clearly trying to align executive incentives with long-term shareholder value through significant equity awards and performance-based bonuses. The fluctuating financial results, particularly the net losses in recent years, are a clear challenge. But the positive trend in adjusted EBITDA in 2025 is a good sign. Their focus on product and technology, as seen with the CTO's role and compensation, suggests they are investing in their core capabilities. The reliance on stock awards for a large portion of executive pay means the leaders' fortunes are tied to the stock price, which could create real motivation but also exposure to market volatility. The pay versus performance charts are a bit concerning, while they have been paying out significant compensation even during periods of strong losses. The recent improvement in adjusted EBITDA and positive shareholder return signal a potential turnaround, which the current executive compensation structures are designed to reward. The significant equity awards, especially the performance-based ones tied to stock price hurdles, are a clear bet on future growth and a positive outlook from the compensation committee. Alright, that is our breakdown of Stitch Fix's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the pay is justified? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. And hey, do not forget to check out the Discord community in the description for continued discussion. Thanks for watching. See you next time.